Hello and welcome. In this video, I will share the US domestic liquidity month-to-month changes. These are important because liquidity will either act as a tail or headwind for your stock and crypto investments. We want to make sound investment decisions, so knowing where liquidity is moving and if it is helping or preventing us from making any gains is actually really important. So I am going to share my monthly update with you guys on YouTube from now on. So be certain to sub and like these videos if you want to see more and support my work. So let's dive straight into the content. The first thing we are looking at right now is the dollar index, the DXY. The dollar is one of the most important measures we need to take for liquidity because the movements for the dollar are important for the whole world. A weakening dollar, a dollar price going lower, is actually good for risk on assets like stocks and crypto, and a strengthening dollar, which is moving up in value, is actually bad for risk on, but it is good for risk off assets. So you need to know these movements in order to make an assessment. So what are we seeing right now? The dollar has been ranging since 2023 between the blue lines. Then in 2025, we finally broke lower, and we also retested but failed to break back into the range. We then broke the uptrend line, which you can see in red, the small red line, and now we are ranging towards the lows once more. My bias personally is that the dollar is going to move to the red boxes, which is a high probability target of 95, and we could even see follow through all the way lower into 89 to 90, which is less likely right now, but still probable. What I do want to add to the conversation is that generally we have a president that wants a weaker dollar, so that also moves the dollar lower. As you can see, since Trump basically is president, we have seen a significant move. But also when we see rates from the Fed going lower, and they are lowering rates and they are easing policy once more, then very often we see a weaker dollar as well. A weaker dollar is also good for trade worldwide, and it's also good for the US in that term. So all the combinations together basically give me a bearish bias for the dollar. You can also see that the dollar moves cyclically, and I've tried to measure that on this chart. You see a surge upward, then you see a breakdown, a range, and then a final push lower. Both the range and the move lower are bullish for risk on assets like stocks and crypto. We are now in number 3, which is breakdown, and we are now currently sitting at a plus 10-year range, at the lows of that range. We tested those lows prior in 2021 and around 2014, and we are back at that same level. I do suspect, because of the things I just mentioned, that we are going to break the range, either it be a fake out before we turn back in or a sustainable move, but my general bias remains lower as of right now. This is basically good for stocks and crypto. If you look at this specific chart from the Fed, this is a Federal Reserve chart, then this is showing us the domestic liquidity. Domestic liquidity has been pretty tight, which means has been pretty low. We have been trading against the lows, which we have seen in 2024, but we also saw at the bottom of the mini bear market in 2022. So near the end of quantitative tightening, it is often the case that domestic liquidity is a bit in stress. A bit in stress means that it is near the lower end of the range, which we were. We are now, because we ended QT and we are now expanding the balance sheet from the Fed in the US, we are now rolling over back, and we will likely see this short trend up once more, as we have seen also in many other occasions. So this is basically looking as if it has bottomed, which is good for risk on assets, because this chart going lower is very negative, and it stagnating or moving higher is actually positive. When we look at the cash reserves from domestic banks, big or small, then we see the same kind of picture. Ever since 2020, bank reserves have continued to go up. And they have remained above levels from the banking crisis, which we have seen in early 2023, in March of 2023, actually, and we have not traded below them. So there's actually not really a concern to look at banking stress right now, because the assets they have are still above those small crisis levels. They are still healthy right now, even though people on FinTweet may suggest otherwise. So this is also bullish for risk on assets. If we do break lower, then it could mean that there is a lot of stress in the banks, and that could be a negative catalyst. But as you can clearly see, the green line, small banks have been trending upwards. Big banks have been consolidating near the lows, but have also basically gone up in their savings. And that is driven because of the Fed rate cuts. The Fed rate cuts basically loosen fiscal policy for the banks, which increases their profits, and they can have more reserves as well. On this chart, we basically see the Treasury general account. When this account moves lower, it is often providing liquidity into the market, and when it moves higher, it is sucking up liquidity. So a move lower is basically supportive, and any moves higher is basically limiting stock and crypto prices. What we have seen is that we have refilled the levels which the Fed also announced they wanted to hit, around 850 million by the end of the year. We actually overfilled roughly to 1 trillion, but we gave that back in Q4 into the markets because this was driven by savings they made through the government shutdown, and they basically put that liquidity back in the system. We are expected to see the same as we have seen in 2024 in Q1. We are not going to see a big drainage of TGA as we have seen prior while QT was present. Now that liquidity is coming back by printing, by expansion of the balance sheet, because we are in quantitative easing, there is no need for the treasury account to be drained to support markets. So they are announcing that it will remain flat, at least it will in the first quarter of 2026. This is basically a neutral chart for now, but remember, if it moves lower, it is actually putting money in the markets. If it's moving higher, it's doing the opposite. RRP has also been a big driver of holding up markets because it has done the same. RRP has basically provided us with a lot of liquidity while we were in QT. And now the balance sheet has been reduced to near zero near the end of Q3 of 2025. And that is often corresponding with an end of QT, which we also saw. The Fed announced they would expand the balance sheet from this year going forward. And we also see the reverse repos seeing inflows, and they are going to build up that liquidity reserve as they have also done in 21 and 22. So this will no longer provide liquidity into the markets, but there is also, like with the TGA account, there is no need to support markets right now because the Fed is expanding the balance sheet. So these accounts can now accumulate, can now grow, and will be used in the future once more. So it is basically a neutral reading right now. The GLI, Global Liquidity Index, has also broken out in 2025. We saw some consolidations, but then near the mid of the year or near the end of Q1, actually, we broke to new highs and have been in a steady uptrend. We saw some stagnation in Q3, but near the end of the year, we saw another influx of liquidity. And whenever this chart is moving higher, that is also supportive for markets. So overall, it is looking really good. And as I have posted on X, and you can follow me right here if you please to, then my conclusion is as followed. I expected we see positive rollover in the first quarter into now. And that's basically what we are seeing. Liquidity is positive. It is generally positive and kind a tailwind for risk on assets like stocks and crypto. And we are seeing the balance sheet being expanded with 65 billion in Q1. So these liquidity expansions are supportive for higher asset prices, and I really think that this is a good tailwind for the markets. So I will give you another update every single month, but right now it is looking as a very positive catalyst for both higher stock prices and higher crypto prices. It does not imply that because the liquidity is a tailwind that prices will go up, but it's a big surplus whenever liquidity is sitting at the same side of your trade, which is basically long for me as a professional investor. If you want more, or if you have any questions, let me know in the comments below. Like and subscribe if you want to see more of this on a monthly basis, and I will see you in the next video. Take care.